You are listening to KeyStone's Stock Talk Podcast, episode 54. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at CCOM Satellite Systems, CMI on the TSX Venture, a dividend-paying microcap stock which develops, manufactures, and deploys commercial-grade mobile satellite-based technology for the delivery of two-way high-speed internet, VoIP, and video services into vehicles. This is a stock we owned years ago and sold after a very strong return. The company just reported a strong quarter of growth, and a listener asks us our thoughts on the stock going forward. Our star of the week is WesternOne, symbol WEQ on the TSX, a provider of construction, heat services, and aerial equipment rentals to businesses in the construction, infrastructure, film, and television industries in Western Canada. The stock jumped 31% this week after reporting the business would be sold to United Rentals for a base cash purchase price of around $120 million. Finally, our dog of the week is Aurora Cannabis, symbol ACB on the TSX, a leading producer and distributor of medical cannabis in Canada and internationally. The stock dropped 27% this past week and is hardly alone in the cannabis segment, which has taken its lumps following legalization mid-last week in Canada. Is this company a dog or a potential opportunity? We'll let you know. Now let's dig into the show. I'd like to welcome back my co-host, KeyStone's VP and Senior Analyst, Mr. Aaron Dunn. How are you doing?
Doing great. How are you doing today, Ryan?
Doing well. Definitely saw kind of a negative market overall in the markets this week. Quite a sell-off in the cannabis stocks. In fact, it was just a continuation of the selling we saw post-legalization. It could be a case of buying on rumor, selling on news. I think I might be more inclined to say the industry just became real. And now, from an investor perspective, it would be more a put up and shut up type scenario. In other words, start posting real cash flow to justify your valuations, or you will have, you won't have a place in most portfolios, or at least most fundamental portfolios out there. I don't know what your take is.
And profitability too. Yeah, I think that you're exactly right. It's now the speculation is behind us more or less, and these companies actually have to produce as real businesses in a real industry. And as you know, Ryan, one of the things we've been looking really closely at is just the supply and demand dynamics post-legalization. And generally, the expectation is that consumption is going to be about 800,000 kilograms per year in Canada domestically. And if you look at just the top 10 players, for instance, they have plans over the next 2-3 years to build production up to over 2 million kilograms, so double the required consumption. Double what the demand will be. So it's obviously there's some expectation that there's going to be a market outside of Canada, but now that these companies are actually going to start to sell legal recreational marijuana, we're going to see what that translates into on their financial statements, and if any of them can actually get profitable. And I think there's going to be a major shakedown of the industry where a lot of these smaller players are going to have trouble competing against the bigger players, and the bigger players as well are gonna come under pressure somewhat on a price perspective, competing with each other.
Yeah, and like we said, it's going to be put up or shut up going forward. Show me the money of Jerry Maguire fame. That's what you're going to see going forward, and investors are going to ask for that now. So they're going to have to justify some of the valuations out there. Some of the companies may be able to do it, and there will be definitely some out there that we can see that will fail.
Yeah, another thing to consider as well is that when you look at the forecasted demand figures, that's total demand. So that includes the black market and the legal cannabis market. And Deloitte, for instance, they're forecasting that about a third of cannabis sales in 2019 are still going to be accounted for through the black market. But it's possible that the actual number can be quite higher, because distribution, for example, is controlled by the provinces. And I mean, just for example, in British Columbia, all legal marijuana has to go through the liquor distribution branch, just exactly like our liquor does. So the liquor distribution branch here is going to license the retailers and control that. Well, how quickly can they ramp up the legal retail distribution chains? I mean, if it takes years to really gain, the traction that the illegal market really has here right now. I mean, if you look in Vancouver, there's dispensaries all over the city. Just because cannabis is legalized now, those are still illegal dispensaries. They're not licensed to sell. They're not selling product through the liquor distribution branch. So you wonder how quickly can the legal cannabis market catch up to a black market that is really already very established. And if it can't, then and it's a slow move forward getting these licensed distribution chains up and running, then people are still going to purchase their product from the black market.
Yeah, I mean, there's certainly, I mean, I agree. There's certainly action in the sector, though. I mean, we saw, I think, just this week, company Bevo Agro, which is they were a grower of tomatoes, hothouse tomatoes, got bought out by a marijuana producer. That just is going to bring more potential supply onto the market, and that's what we're seeing. So it's going to be interesting to see the way it plays out. Now let's look at and that really actually ties into our dog of the week, and we could have picked almost any company in the marijuana segment this week, but we're going to look at first Aurora Cannabis, and Aaron, you're going to look at that. From our Stars and Dogs segment, it's time for this week's Dog.
Yeah, nice segue into Aurora. So Aurora Cannabis, the symbol is ACB on the TSX exchange. It's a cultivator of cannabis, the second largest Canadian cannabis company by market cap. It's about a $10 billion market cap company, and this is a great example. The stock has lost almost 30% of its value since legalization occurred. So just over the last several days here, 27 to 30% drop in the company's value. And Aurora has a reputation as being one of the companies that's really powered by hype. They've been the most acquisitive of the companies. They've announced some major acquisitions. Some analysts have said that the prices that they're paying are ridiculous, but they had acquired, I believe it was the fourth largest company, MedLeaf, not too long ago. They've made several other acquisitions. They're continuing to do so. So it was actually on a price to sales basis the more expensive of the big three marijuana companies. But like all the marijuana, like the major marijuana companies, the revenue has been good for this company. So in the last year, the company's reported $55 million in revenues, up 200% compared to the year before that. But big net loss, so an adjusted net loss over that period of $116 million. So nowhere near profitability. And this is a company that's been it's suffered with the market. So this is the recent decline in Aurora has not been a company specific thing. Really, it's just been suffering with the market. But of the biggest players, which would be Canopy, Aurora, and Afria, Aurora has suffered the biggest decline since legalization has occurred. So the company going forward, from our perspective, there's a lot of risk. There's a lot of unknown. It's even with the drop in its share price, it's still a very highly valued company, probably close to about 200 times sales. And if you just put that into perspective, I mean, the top tech companies in the US trade at typically less than 10 times sales, or around 10 times sales. So, that just gives you an idea of how much this company has to grow in order to earn that valuation, and what types of expectations are baked into the current share price, even after this decline. So not trying to single Aurora out. All the companies have suffered over the past week here, but it has been the hardest hit, and it is our dog of the week.
Yeah, that's a good summary. And I think we were asked many times when we just a couple weeks ago, right ahead of legalization, our thoughts on the valuations in the sector and can we recommend something there? And, given the valuations at that time, we just, we could not see the value in the companies in the near term and even over the next year at least that would justify the massive valuations the segment was getting at that point. We were very happy that we did not at that point recommend anything to our clients. And, we'll continue to see if there's opportunities there. We're monitoring all 110, 109 companies in the Canadian markets that are in this segment. But until we see value and see some confirmation in terms of profitability, I think we'll be staying on the sidelines largely. Now let's take a look at our Your Stock, Our Take for this week. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. It is a company we are very familiar with, CCOM Satellite. A listener asked us, CCOM just reported great results. Is the growth story back intact here? That's from Martin Murin. Now, CCOM is a company, trades around $1.20 right now, market cap around $44 million. What does the company do? They are a leading developer, manufacturer, and deployer of commercial-grade mobile satellite-based technology for the delivery of two-way, high-speed internet, VoIP, and video services into vehicles. Essentially, they make antennas. Now, CCOM has developed proprietary mobile auto-deploying antennas that deliver broadband and satellite into vehicles while stationary virtually anywhere one can drive. There are more than 7,000 CCOM antennas that have been deployed in over 103 countries worldwide. So the company's done a great job in its niche market. Now, the last quarter is really what is exciting the market, exciting this listener. On this stock, you saw revenue growth of 71%, up to $4 million. A net income grew up 392% to $641,000, up from $130,000 in the same period last year. It was a tremendous growth quarter for the company, but the company has gone through some tough times as the mining and energy sectors were in significant downturns over the last several years. They have seen pickup in activity in those segments, new orders coming in, which have buoyed these results, really boosted these results in the last quarter. But on a trailing basis, the company still trades with a PE of around 23, 24 times earnings. Now, there's a great cash position here, $15.4 million, or about 35% of its market cap is in cash, and there's really no debt here. So if you remove that cash, it trades at relatively more reasonable valuations, but it's certainly still not cheap. Like I said, the balance sheet is great here, but the growth has been spotty. The current trailing valuations are really not cheap, especially for a microcap stock. But if it continued to post growth and profitable growth like we saw in the third quarter, the multiple will quickly move lower and the stock will look more attractive. It pays an attractive dividend and has paid that for years now. It's over 4%. And at present, the stock for us is more of a hold. But if we continue, like I said, to see these contract wins, further growth quarters, as we saw in the profitable Q3 that we just saw from the business, the stock would once again come onto our radar, and be a stock we're closely watching right now to see if it can replicate that growth we saw in Q3.
So Ryan, what would you think would be an appropriate valuation to pay for a stock like CCOM?
Well, I mean, because it does have some cyclicality to its business, I would play a below market multiple. So right now it's trading at an above market multiple. So if the market was trading at 18 times earnings, I would like to, buy it in the 15 times range, for example. And it would all depend on the certainty on growth going forward. But, if you could buy it at a below market multiple and you thought for like a 2 to 3 year period it was going to exceed the growth of the market, then that would be something, a level I'd be more comfortable buying it at. Now we're going to move to our weekly star of the week. This week, it's WesternOne Inc., symbol WEQ on the TSX. Aaron, I'm going to let you take that one away. From our Stars and Dogs segment, it's time for this week's Star.
Sure. WesternOne Inc., currently trading for a price of $2.14, $35 million market cap. Just this week, the stock has jumped 31% from $1.61 to over $2. The stock is up 41% year to date. So WesternOne's principal business platform is WesternOne Infrastructure Services. And this is a provider of construction services and aerial equipment rentals to construction and infrastructure, film and television industries in Western Canada. So on October 22nd, the company announced that its equipment rentals and heat business would be sold to United Rentals for a price of 120 million Canadian on a cash-free, debt-free basis. So essentially what this is this sale is resulting in a wind-up of the operations and a liquidation of the assets, which are not being sold in this transaction. So WesternOne is essentially liquidating its operations potentially. Looking at the recent financials, in the second quarter of 2018, revenue was $17.9 million, which was up 27% from the same quarter in the previous year. However, the company did report a net loss of $7.2 million compared to $12.2 million in the previous year. Now, I remember following this company several years back. It was one of the companies that really got hit hard when the oil price started going down. I remember that debt was a major issue for them, and I see that's still the case here. They have a debt to equity ratio of 7.2 times, so high debt levels. But the big story here is that the company's sale of its operations and its coming liquidation, assuming that this transaction goes through, shareholders will receive a payment from the company. And so far, the market price has increased to match this value. So again, assuming that the transaction goes through, the company's fundamentals really don't matter at this point in time. It's essentially winding up the business. So this is a company that we're probably not going to see much more of in the future, but it's definitely done well over the past week, and I'm sure that some of the investors are happy to get their money out. And this story is our star of the week.
Yeah, and for investors, probably for that company, it's it's getting some capital out of that business that was really, it was a really cyclical type business, and one that we'd looked at a number of times, but it just had been too debt laden, too cyclical to be a business that we thought of as a long-term investment. And that's going to wrap up our show for this week. I'd like to thank everybody for listening, thank our question that came into our Your Stock, Our Take segment, and encourage all of our listeners and our clients to continue to send in questions to our Your Stock, Our Take segment. Send those in on their social media channels, or just email or call our office and we'll answer your questions that way. Again, Aaron, I'd like to thank you for co-hosting with me and wish all of our listeners out there profitable investing.
Thank you. Profitable investing.